Before we begin, none of this is financial advice. This is educational content only. Do your own research. Past performance does not guarantee future results. You think you own 500 stocks. You don't. This is the S&P 500. 500 companies, each represented by a square here. You probably think you own a little piece of all of them equally. That's what diversified means, right? But here's what actually happens. Look at this number. 35% of your money sits in just 10 companies, not 500, 10. The rest of that grid you just saw is almost irrelevant in terms of where your dollars actually go. This is how cap weighting works, and it explains exactly why this happens. Apple, at the top of the index, gets about 500 times more of your investment than the smallest company in the S&P 500. The formula is simple. Your weight in the index equals the company's market cap divided by the total market cap of all 500 companies. The bigger the company, the more you buy. And the more expensive it gets, the more you keep buying. So what if we flip this around? What if every company got the same vote? Each stock would get exactly 0.2% of your money. That is what equal weighting does, and it already exists. It's called RSP, the Invesco S&P 500 Equal Weight ETF. Same 500 companies, but every quarter it mechanically sells what went up and buys what went down. It is automatic contrarian investing. So how does this actually perform over the long run? Over 20 years, equal weight returned 11.48% per year. Cap weight returned 10.29%. That 1.2% gap doesn't sound like much, but compounded over 2 decades, it becomes a massive difference. Source, S&P Global Research. But hold on, the last 10 years told a completely different story. SPY, the cap-weighted fund, returned 251%. RSP, the equal-weight version, returned 207%. That is a huge gap in the other direction. Why? Because the Magnificent Seven, Apple, Microsoft, Nvidia, Amazon, Google, Meta, Tesla, drove almost everything. When a handful of mega caps are on a tier, cap weighting wins by a mile. So that raises the uncomfortable question, is equal weight actually worse? To answer that, we need to understand WHY equal weight outperforms when it does. And here's the key insight. It is not because equal weighting is some kind of magic. It outperforms because of specific documented factor premiums. Let me break down what that means. Factor number 1 is size. Because every stock gets the same allocation, equal weight gives you about 3 times more exposure to smaller companies than a cap-weighted fund does. And smaller companies have historically returned more. The size premium has averaged about 1.87% per year since 1963. S&P Global themselves described equal weight indexing as, quote, one-stop shopping for size and value. They know exactly what's happening here. Factor number 2 is value. Here is where the quarterly rebalance really matters. When RSP rebalances every quarter, it is systematically selling the stocks that went up. Those are the ones that got more expensive, the growth stocks, and buying the stocks that went down, which are now cheaper, the value stocks. This is mechanical contrarianism. It creates an anti-momentum tilt that pushes your portfolio toward cheaper companies. Over the long run, cheaper stocks have outperformed more expensive ones. That is the value premium. And we can actually measure how much of equal weight's outperformance comes from these factors. When researchers run a FAMA French factor regression on the return difference between equal weight and cap weight, they find that 75% of the outperformance is explained by the size premium alone. The R squared is 0.75. Add the value factor and it accounts for nearly all of it. This is documented by Advisor Perspectives in 2023, by ETFs Business School Research, and by Vanguard's own analysis. The outperformance is not random. It is driven by measurable factor exposures. Here's the bottom line. When you invest in an equal weight fund, you are not picking stocks. You are mechanically harvesting factor premiums that have beaten the market for decades. You are systematically buying size and value without having to think about it. But of course, there is a catch. Several of them, actually. The first catch is turnover. A cap-weighted fund like SPY barely trades, about 4% turnover per year. Equal weight churns through about 25% of its portfolio annually. That is 5 to 10 times more trading. Now the expense ratio gap between these funds is only 11 basis points. That is not where the real cost lives. The real cost is something else. The real cost is taxes. Because RSP rebalances every quarter, it triggers capital gains distributions every single year. If you hold it in a taxable brokerage account, you pay taxes on those gains annually. That eats into your returns. But if you hold it in an IRA or a 401k, there is no annual tax drag at all. You capture the full factor premium with nothing leaking out to the IRS each year. The third trade-off is drawdowns. In major crashes, equal weight has fallen harder. RSP dropped 60% at its worst. SPY dropped 55%. More diversification did not mean less downside. It meant different downside. Smaller companies get crushed in recessions, and the volatility pattern is weird. Month to month, RSP is actually calmer. But week to week, it is jumpier. It is a different kind of risk entirely. So where does equal weight actually belong? In a taxable account, the premium shrinks because of that annual tax drag we just talked about. But in an IRA or a 401k, the full premium is intact. The simple rule, equal weight belongs in tax-deferred accounts. Now, what about international equal weight? The options here are surprisingly sparse. In US markets, you have EWJE, that is Japan only, at a 0.25% expense ratio. PXF uses fundamental weighting for developed markets outside the US. FRDM is a freedom-weighted approach for emerging markets. But here is what does not exist. The MSCI EAF Equal Weight Index exists. The MSCI Emerging Markets Equal Weight Index exists. The All-Country World Equal Weight Index exists, but 0 US-listed ETFs track any of them. There is one global equal weight ETF, NWEQ, but it is UCITS only, Europe only. US investors cannot easily buy it. The irony is that So when does each strategy win? Cap weighting wins when mega caps dominate and growth beats value. Exactly what we saw from 2015 to 2025. Equal weighting wins when market participation is broad and value beats growth. In 2026, equal weight is actually ahead. Is the regime shifting? Nobody knows for sure. But if you are 100% in cap-weighted index funds right now, you are making a bet that the concentration trend of the last decade continues. Here's what I want you to take away from this. Cap weighting is concentrated, tax efficient, and momentum driven. It gives you more of what went up. Equal weighting is diversified, factor tilted, and mechanically contrarian. It systematically buys what went down. Neither strategy always wins. You don't have to pick one, you can own both. But you should at least know what you actually own when you buy that index fund. And remember, none of this is financial advice. This is educational content. Do your own research. Past performance does not guarantee future results.